Friday morning pre-market, I opened up my Robinhood account and saw this warning. My balance had dropped below the margin threshold. Stay tuned and I'll let you know if Friday's market recovery was enough to get me out of margin trouble. I'll update you on the dividends I received this week, and I'll let you know which high-yield ETF I sold this week and how I invested the profits. My goal is to find an infinite stream of dividend income, and I'm trying to turn $1,000 of Robinhood's money into $1,000 of my money. And remember, I'm not offering any type of financial or investment or other advice. I'm just showing you what I'm doing with my money. You need to do your own due diligence for your investments. Let's get started. Friday morning, things weren't looking great. Robinhood was flashing all kinds of warnings to me about my account deficit. I've run into this a couple of times before and ended up having to add shares of PAAA to bring my account balance over the $2,000 threshold and back into compliance. On Thursday evening, the account dropped to a low of $1,985. But fortunately, Friday was a great day for the market and cryptocurrency. My account value climbed all day and ended up over $2,030, and this resolved my margin deficit. I'm still in the high-risk margin status, only 1% above my maintenance minimum, but I haven't had to add any shares of PAAA to buffer this. I know I'm still in a precarious position, and a bad day in the market on Monday can drop me right back into margin call territory. But right now I'm going to ride it out and hope that my investments gain value. Let's take a look at the dividends for the week. NVYY paid me 33 cents per share for a total of $3.85. I split that dividend in half. 50% of it was invested into SPY. The other 50% I'm holding aside right now until I decide what I'm going to do with this particular ETF. NVYY continues to pay me a high yield. This particular distribution is equal to about a 98% annualized yield, and it's paid me almost $125 during this experiment. But as I've noted in some previous episodes, the price return has not been great, and I'm considering my options on selling this investment and buying something else, but no decision has been made on that yet. I received my first blocks distribution at 13 cents per share. This represents a 36% annualized yield, and that's the yield that I expect to receive for every distribution. Because the weekly distribution is less than $1, I'll generally have to save up a couple of distributions before I can reinvest back into the fund. If we scroll over and take a look at HOOW, it paid me 44 cents per share for a 96-cent distribution. That works out to about a 71% annualized return. More on HOOW in a minute. I received my final dividend from SNOI. It paid me an ominous-sounding 6.66 cents per share, which works out to about a 37% annualized yield. Finally, I received my PAAA dividend, $8.75. I expect this yield to go down bit by bit as the Fed lowers interest rates, but I'm still happy with this investment. 100% of this distribution went back into PAAA. Last week, I discussed my plan to sell SNOI and buy Chippy. They are both yield max funds that seek current income, but they have some differences. SNOI uses a synthetic position, covered calls, and call spreads, while Chippy uses equity and an option income overlay. SNOI has the potential for much higher yield, but the share price just continued to fall and fall. Chippy offers a lower yield, but it is more stable, and it offers a diversification that SNOI does not. So this week, I was able to sell SNOI and buy Chippy. This is my SNOI purchase log. You can see at the top that I initially purchased at about $16.54 per share. And it's fallen the 15s down to 12, 11. I ultimately sold it this week at $8.68 per share, taking a massive loss. I was then able to turn around and buy Chippy at $56.84 per share. This is the weekly chart for Chippy. I was able to buy somewhere in this vicinity of the $56.84, and then on Friday it had a nice pop all the way up to currently at $60.10. So even though I sold my SNOI shares during a bad week and at a loss, I was able to pick up Chippy while it was down, and my first Chippy dividend should come next week. This week, as part of my portfolio makeover, I decided to take a good hard look at HOOW, the Round Hill Robinhood Weekly Pay ETF. This fund is structured exactly like COIW, which I sold recently. What's unique about the Round Hill Weekly Pay ETFs is that their goal is to provide 1.2 times the calendar week return of the underlying stock, in this case Robinhood. It offers a really high yield, currently only 55%, but it's been a lot higher than that in the past. We can see that the fund is pretty new. It just came out in July of 2025. For assets, it only has two. It's swap agreements and about 3% of HOOD stock, which is actually significantly less than the Coinbase version, which I believe had about 12% coin stock. I'm not going to go over the mechanics of this fund since I recently did that with COIW, and it's exactly the same. I do, however, want to talk about fund performance. In this chart, we're looking at the total return of HOOW and HOOD since HOO's inception date last June. HOOD is up about 6%, and HOOW is up about 0.25%, which is pretty interesting because HOOW is trying to track 120% of the total return of HOOD from week to week. So one would expect that the total return for HOOW would be higher than HOOD, but it's not. If we take a look at the 6-month chart, again, they track pretty similar, but this time HOOW is underperforming HOOD, minus 21% to minus 29%. And this underperformance actually exceeds the 120% that we would expect. So that's not a good look. Here's the 1 month. HOOD's price has just been falling, so we'd expect HOOW to fall with it. But since it's leveraged, it's fallen even more in this case. And in the last week, things were really bad. HOOD fell about 10.5%, and HOOW fell about 12.5%, which actually seems to be tracking pretty close to their 120% target. So in total return, this Roundhill fund is doing about what we would expect. But since the underlying has been going down, HOOW has gone down further in total return. But now let's go take a look at price return. We'll go back to the inception date. And this is where things look really ugly to me. HOOD is up about 5.5%, 6%, while the price return of HOOW is down almost 42%. If we take a look at the 6-month chart, very similar, minus 22% and minus 55%. The 1 month, they're both heading down. And over the last week, essentially the same as the total return. So based on the underperformance of Robinhood the stock, leading to worse underperformance by HOOW, I decided to sell. For those of you who haven't followed the series from the beginning, one of my 4 original ultra-high yield ETFs was MISTY, MSTY. I bought $250 worth at about $21 per share, reinvested half of the dividends, and the share price continued to fall. I sold out in November at $10.26 per share, and my investment had dwindled down to $139. I invested those proceeds into HOOW, buying in at about $68 per share. I continued to reinvest half of the dividends, but the share price kept falling. I suspended the dividend reinvestment in early January, feeling like things were going poorly and I needed to make a change. And as you can see, between January 6th and February 5th, when I finally sold out, the share price dropped from $52 to $27 per share. At this point, I only had $58.84 out of the original $250 and the half dividends that I had reinvested. The proceeds from selling HOOW were even less than what I got from selling COIW, which netted me a little over $80. Because my realized loss on my MISTY and then HOOW shares was so great, I decided not to use these proceeds to enter into a new ultra-high yield ETF. Instead, I decided to fold my HOOW position in with the proceeds of my COIW position and invest both of them into blocks, which is the Nicholas Crypto Income ETF. It's a diversified holding that provides exposure to a lot of cryptocurrency and crypto-related companies. And crypto as an industry took a huge hit this past week. So I decided to buy the dip and double down that blocks will be able to pull me out of this hole. Its yield is around 36%, which is a lot less than what HOOW and COIW offered. But if cryptocurrency regains its footing and eventually gets back to the levels it was a month or two ago, my investment in blocks stands to make a lot of money. And one important part about blocks that's different from the other funds is right here, where it says that their primary objective is to seek capital appreciation, and the secondary objective is current income. Since I've lost so much money in my Misty, Koi, and HOOW investments, capital appreciation is needed in this segment of my investment strategy. I'll briefly go over some of the differences between HOOW and blocks. I did a deeper dive a few videos ago when I got rid of COIW, so if you want more information, check out that video. Blocks is a fund by Nicholas Wealth, and it seeks capital appreciation first and current income second, whereas HOOW is trying to pay weekly distributions first, and secondarily it's trying to match 120% of Coin's calendar week total return. HOOW invests in total return swap agreements and common stock, whereas Blocks uses equity and a crypto portfolio with option income overlay. Both of these are high-risk investments. There's only a 2-day difference between the age of these two funds. The price on HOOW has been trending down significantly. Up until recently, Blocks has been at least fairly steady, but with the cryptocurrency downturn last week, its NAV is going down. HOOW typically offers a much higher yield, twice or more compared to what Blocks offers. But Blocks has a more stable dividend compared to HOOW's recent erratic dividends. They're both weekly payers. Technically, they both hold the underlying assets. However, HOOW only has about 3% of Hood stock. Blocks is not leveraged, and it's diversified, holding about 20 assets, compared to HOOW, which only holds Hood. The expense ratios are similar, and Blocks has the edge in assets under management. So I took the proceeds of the sale of HOOW shares and added the half dividends that I had been holding for HOOW, and I was able to buy $62.47 worth of Blocks, which gave me 4.264 shares, and allowing me to average down from my initial cost per share of $18.61. Blocks is trading at $15.29 over the weekend, and I was able to drop my average share cost to $16.67. Haven't been talking about NVYY much recently, but here's how the ETF did over this last week. Down about 2.75%, which overall isn't really bad. The stock market did terrible this week until Friday's rebound. Even with all these changes, things aren't looking great in the portfolio. But Chippy and Blocks are both new. They haven't had much of a chance to do anything yet. I'm hoping that I'm trading off some higher yield for more NAV stability, and hopefully some NAV appreciation. My high-yield ETF investments are down about 50%, which is just terrible. I may keep the WHO and Koi positions in Blocks permanently, or I may break them out later. That remains to be seen. I still got to figure out what I want to do with NIVI. SPY I's value is up to $177, which is nice, but the portfolio as a whole is down about 33% and just seems to be getting worse. So right now I'm looking for stabilization. If you found today's video helpful or entertaining, I'd really appreciate it if you'd like and subscribe. Nothing in my videos should be considered financial, investment, tax, or legal advice. I'm just inviting you along my journey. And if you'd like to learn more about my small account margin strategy, check out the first 5 videos in the series. Good luck hunting those infinite dividends. Take care.